Hi, this is a few videos. I think I'm going to break it up into a few different videos, but this is a couple videos I'm making just on my market outlook. I was thinking of writing a post similar to a blog. I don't have a blog, but a bit of a few pages, but with the amount of graphs and data, I don't think it would have. I think a video is a better format. This is going to go on YouTube, so I do talk fast, but if you want it sped up, you can adjust it to make it faster and with the little cog. So yeah, let's hop into it. First thing I'm going to talk about is stock price valuations, right? So ultimately, there's the economic health and economic outlook that will say whether or not these valuations are healthy, but let's just take a historic perspective and assume that historic growth rates are going to stay constant. In my opinion, and this is sort of the theory I go by. It's a well-known theory where there's three forces. You have productivity, short-term debt cycles, and long-term debt cycles. Productivity is about 2% a year. Short-term debt cycles are about 5 to 8 years, and long-term debt cycles are 50 to 100 depending. And that's like depression, that's 2008, that's sort of at the end of the long-term debt cycle. But I think we're approaching the end of a very big short-term debt cycle, and a lot of times when you have that expansion of credit, you have that expansion of incomes, expansion of net wealth, of net worth. A lot of that is reflected in assets. We see that with housing. We see that with the stock market. So I'll hop into it. First things are consumer sentiment and consumer confidence. So a lot of times before the end of a credit cycle, of an expansion, you have very high consumer sentiment because that's when asset values and incomes are at high levels. So these are two charts. They both go from the 70s till now, and you can sort of get a feel for where levels are historically. They're very high. So let's go into let's see here. So this is the PE of 10 years. It's 10 to try to eliminate the short-term debt cycle and short-term credit expansions from earnings. So with that being said, we're about the level of the pre-Great Depression. We're not .com level if you look at a PE 10, but we're above 2. We're in between 2 and 3 standard deviations from the mean valuations of the market. And what that is percentile-wise, so I can zoom in here. 1 second. So if I zoom in, right now we are at 96.7 percentile as far as valuations go, price to earnings 10. And this is the 2007 peak, this is the Great Depression peak, and this is the tech bubble. So, we're very, very high as far as valuations go. I'll go into the valuations folder next. So these are the two confidence indexes, and this is the housing confidence. Again, assets of all types tend to be inflated at the end of a credit expansion just from the fact that there's more credit. Housing market has actually started to correct this year, partly due to rising interest rates, partly, in my opinion, due to everyone who is typically a house buyer being in tremendous student debt, which is a whole issue on its own and a whole different drag on the economy. But I think the housing market's a very bad place to be going forward. I don't think it's bubbly like it was pre-2008 with mortgages, but something, to a lesser extent, it is still at a top, and it's coming down. Price to sales, 52-year high. You go back to the 90s and price to sales ratios are what they are now. You look at the market capitalization to GDP, again, insanely high. This is regression off the trend of the S&P Composite Index. So like I said, you have different cycles that happen in the economy naturally due to credit. but you have the 2% production. And if we assume that the market follows that historically since 1870 and draw a regression line through that, you can see that if you look at the price of the S&P 500, S&P Composite Index, it is insanely high off the regression. Here it is drawn out with inflation adjusted, obviously, price since 1871, and you have variance down here, 116% variance off the regression, and 134 was .com. Here is stock market capitalization GDP for the U.S., also known as the Buffett indicator, since he claims publicly that it's a really good way to figure out when to buy stocks when stocks are cheap, and it's at a level now of the end of the .com bubble, so pretty scary as far as capitalization to GDP. And this is another one. This is the Wilshire 5000 to GDP, again above actual .com levels. And one of the last things for valuations is an average of 4 valuation indicators. One is cyclically corrected, one is not. It's a PE made by Crestmont, and one looks at assets and book value as a ratio of companies, and one is the S&P Composite variance from deviation from the regression. And if you average the 4, it is 113% off the mean, which is approaching 3 standard deviations valuation-wise. And that only the last time we were above 3 standard deviations valuation-wise was .com bubble. Great Depression, pre that bubble was only 2 standard deviations. Pre-2008, we were in between 1 and 2, and we're never really above 2, besides in bubbles. So ultimately, multiple valuation indicators are all saying the valuations are insanely high. Now, the only way that would be reasonable is if there's a fundamental change in the economy where outlook for the next 10, 20, 30 years of these businesses, of the earnings they'll be able to return to shareholders, are also very elevated. So here's S&P 500 with the cyclically adjusted PE ratio, again 116% above regression, and the price to earnings are very high above regression as well, 61% above regression, equivalent to pre-Great Depression, and only second to .com bubble prices. So pretty scary valuations out there. I'm gonna talk about debt in this as well, since it sort of fits in. Probably just about the margin debt, and I'm going to talk about other types of debt when I talk about the economic health, which I think I'm going to make a different video for, or I might tie it into this one, not sure yet. But look at the margin versus the S&P 500. So I'm thinking there's going to be a very big correction. And one of the, like I said, there's a positive feedback loop on the credit expansion on the way up, and also a positive feedback loop expansion or contraction on the way down. And one of the forces behind that contraction in a market is margin. And margin levels, this actually is from July, and I believe it's higher in September and August, but I'm not 100% sure. But regardless, historic levels of margin debt, we're talking almost, approaching $1 trillion, $750 million, $750 billion worth of margin in the market, which essentially will act as a catalyst for large downward spikes as people get margin called out. If you do inflation adjusted, actually, we are, and this is, let's do it this, inflation adjusted percentage. So if you look at the growth, starting 1997 is when it's at 0, and then this is percentage growth, inflation adjusted, very, very high. The margin debt growth has outpaced the market. And I honestly think that it's because interest rates have been low for so long post the crisis that people are looking for high yields. There's a lot of extra credit in the system. There's not really any other good way to get yields besides the market, and people tend to leverage up in situations like this. I also think 2016 was going to be a correction where we had the market start to dip. People started dumping their margin, but I think the Trump election sort of added a bit more juice to the fire with tax cuts, and the country sort of got a second wind, and the market's got a second wind, but I don't know how long that's going to last. So that is the valuation side of things. Next, I'm going to talk about the health of the economy, but I think this is good enough. It's a 10-minute video, short and sweet. And yeah, again, the next video we'll talk about, are these valuations fair based on the economic outlook of the U.S. over the next year, 5 years, 10 years, 20 years into the future? Because ultimately that's how markets should price equities, is their earning power over years to perpetuity technically. But yeah, so I'd love to know your thoughts on this. If you saw it, I'm planning on emailing this to some people whose opinions I'd love to hear on these couple videos I'm making. And if you're just, I might post this on some Reddit economic forums or something, just to sort of get people's opinions to see, am I crazy? Does any of this make sense? Especially in the later ones, because valuations are pretty standard, cut and dry things if you look at historic standards. Also, this is from the Dallas Fed, monitoring evidence of building imbalances. The first point he makes is the U.S. stock market capitalization is insanely high, and this was 2017. So it's 2018 now. There's been even more growth in the stock market since then, and I don't think our economic outlook has improved at all. So that's where I'm going to end it. Thanks for watching, and I look forward to hearing comments back.